Picture this: you're checking your investment account during a market crash. Your stomach drops as you see red numbers everywhere. Against your better judgment, you hit sell on everything, thinking you're protecting what's left. 3 months later, the market bounces back, and you realize you have just locked in massive losses. Sound familiar? If you have ever made a money decision you immediately regretted, you're definitely not alone. In fact, you have just experienced what financial advisor Carl Richards calls the behavior gap, and it's costing people millions of dollars every single year. Carl Richards isn't your typical Wall Street suit. He's a certified financial planner who became famous for drawing simple sketches on napkins that explain complex financial concepts. His drawings have appeared in the New York Times, and they have helped millions of people understand why smart people make dumb money decisions. So what exactly is this behavior gap that Richards talks about? It's the difference between what investments actually return and what investors actually earn. Here's the shocking truth: while the S&P 500 has averaged about 10% annual returns over the long term, the average investor has earned closer to 4 to 5%. That's a massive gap, and it's not because people are picking bad investments. It's because they're making emotional decisions at exactly the wrong times. This gap exists because of our very human tendency to buy high when we're feeling greedy and optimistic, and sell low when we're scared and pessimistic. We chase last year's hot stock, panic during market downturns, and constantly second-guess our financial plans. The purpose of Richards' book isn't to make you a brilliant investor or teach you to time the market. Instead, it's designed to help you recognize and correct the behavioral biases that are quietly sabotaging your financial future. Because here's the thing: building real wealth isn't about being the smartest person in the room. It's about managing your behavior and making decisions that align with your long-term goals, not your short-term emotions. Over the next half hour, we will explore Richard's insights on why we make these mistakes, how to recognize them in real time, and most importantly, how to build a framework for making smarter financial decisions. By the end, you will understand that financial success isn't about perfect knowledge, it's about perfect behavior. Part 1. What is the behavior gap? Let's start with a sobering statistic that should make every investor pay attention. Research from Dalbar, a financial services market research firm, consistently shows that investors earn significantly less than the actual returns of the investments they choose. We're talking about a gap of 3 to 5% annually in many cases. Over 20 or 30 years, this difference compounds into hundreds of thousands of dollars in lost wealth. But why does this happen? It's not because people are picking terrible investments. The culprit is much simpler and much more human: emotional decision-making. Here's how the behavior gap typically plays out. When markets are soaring, and everyone's talking about their investment gains, we feel confident and optimistic. This is when we tend to buy more, convinced that the good times will keep rolling. We're essentially buying high because we're feeling good about the future. Then, inevitably, markets decline. Maybe it's a correction, maybe it's a full-blown bear market. Suddenly, those same investments that seemed so smart are losing money. Fear kicks in. We start imagining worst-case scenarios. What if this time is different? What if the market never recovers? What if I lose everything? So we sell, locking in our losses and essentially buying high and selling low. The critical insight that Richards emphasizes is this: these aren't character flaws or signs of stupidity. They're predictable human behaviors that have been hardwired into us through evolution. Our brains are designed to help us survive immediate physical threats, not navigate complex financial markets. The first step to bridging the behavior gap is simply recognizing it exists. Once you understand that your emotions are constantly trying to hijack your financial decisions, you can start building systems to counteract them. You can't eliminate emotions from investing, and you shouldn't try to. But you can learn to manage them. The awareness itself is powerful. When you feel that urge to make a dramatic change to your portfolio, you can pause and ask, am I about to contribute to my own behavior gap? Often, just asking the question is enough to stop you from making a costly mistake. Part 2. We think we know more than we do. Here's a question that might sting a little. How many of you have ever thought you could time the market? Maybe you noticed a pattern in stock prices, or you had a gut feeling about where things were heading. If you're nodding along, don't worry, you're in good company. We're all guilty of this. Richards points out that humans are essentially overconfidence machines. We have this remarkable ability to convince ourselves that we know more than we actually do. In behavioral finance, this is called the illusion of knowledge, and it's one of the biggest wealth destroyers out there. Think about it. We live in an information age where we have access to the same data, research, and analysis as professional fund managers. We can pull up charts, read analyst reports, and follow market news in real time. All of this information makes us feel informed and confident. The problem is, feeling informed and actually being able to predict the future are two completely different things. The financial media doesn't help. Every day, we're bombarded with predictions, forecasts, and expert opinions about where markets are heading. The top 10 stocks to buy now, why this sector is about to explode, the crash that's coming in 2025, these headlines are designed to grab our attention and make us feel like we're missing out on crucial information. But here's what Richards wants you to understand: even the professionals get it wrong most of the time. Studies consistently show that the majority of actively managed funds underperform simple index funds over the long term. If highly educated, well-resourced professionals can't consistently beat the market, what makes us think we can do it from our kitchen table? The noise of daily market commentary makes it incredibly difficult to distinguish between useful information and meaningless chatter. Richards calls this the difference between signal and story. The signal is the long-term trend of markets generally going up over time as the economy grows. The story is everything else: the daily ups and downs, the political drama, the fear and greed that drive short-term price movements. The antidote to overconfidence isn't cynicism or paralysis. It's humility. Humility means acknowledging that the future is uncertain and that your ability to predict it is limited. It means making decisions based on probabilities rather than certainties. It means building a portfolio that can handle multiple scenarios, rather than betting everything on one prediction. Humility in investing actually leads to better outcomes than confidence without data. When you accept that you don't know what's going to happen next, you're more likely to diversify, more likely to stick with your long-term plan, and less likely to make dramatic changes based on short-term market movements. Part 3. Financial decisions are emotional decisions. Here's something that might surprise you: money isn't really about math. I know that sounds crazy. After all, we're dealing with numbers, percentages, and calculations. But Richards makes a crucial point. That changes everything about how we should think about financial planning. Financial decisions are emotional decisions, disguised as logical ones. Think about the last major financial decision you made. Maybe it was buying a house, choosing a retirement contribution amount, or deciding how much to spend on a vacation. On the surface, these seem like rational choices based on budgets and calculations. But dig deeper, and you'll find emotions driving every decision. When you bought your house, were you just calculating mortgage payments and property taxes? Or were you also thinking about the pride of ownership, the security of having your own space, and the fear of being priced out of the market? When you chose your retirement contribution, were you purely optimizing for tax benefits? Or were you also wrestling with the fear of not having enough money in old age, balanced against the desire to enjoy your money today? Richards identifies several key emotions that consistently impact our financial behavior. Fear is probably the biggest one. Fear of losing money, fear of missing out, fear of making the wrong choice, fear of not having enough. Then there's hope, hope that this investment will be the one that makes us rich, hope that we will time the market perfectly, hope that we won't need as much money as the experts say. There's also guilt, especially around spending. How many of you have felt guilty about buying something you wanted, even when you could afford it? Pride plays a role too. We want our investment choices to reflect well on us, which can lead to showing off or taking unnecessary risks. But here's what makes this even more complicated: our financial emotions don't exist in a vacuum. They're constantly influenced by what's happening in our lives. Going through a divorce? You might become more risk-averse with your investments. Just got a big promotion? You might feel invincible and take on too much risk. Had a health scare? Suddenly, having accessible cash becomes much more important than long-term growth. The key insight here is that you shouldn't try to eliminate emotion from your financial decisions. That's impossible and probably not even desirable. Instead, you need to acknowledge emotions and learn to manage them. When you feel a strong urge to make a financial move, pause and ask yourself, what am I feeling right now? Am I making this decision from a place of fear, greed, or anxiety? Sometimes, just naming the emotion is enough to give you perspective. I'm feeling scared about this market volatility, and that's making me want to sell everything. Once you recognize the emotion, you can ask whether it's a useful guide for this particular decision. This doesn't mean emotions are always wrong. Sometimes fear is telling you about a real risk you need to address. Sometimes excitement about an opportunity is worth exploring. But emotions should inform your decisions, not drive them. The goal is to make financial choices that align with your long-term values and goals, not just your current emotional state. Part 4. The cost of chasing trends. Let's talk about something that probably hits close to home for many of us: the irresistible urge to chase the latest hot investment trend. Whether it's tech stocks in the late 90s, real estate in the mid-2000s, gold after the 2008 crash, or cryptocurrencies more recently, there's always something that seems to be the next big thing. Richards calls this behavior performance chasing, and it's one of the most destructive patterns he sees among investors. Here's how it typically works: an asset class or investment strategy performs really well for a while. The financial media starts talking about it. Your friends start bragging about their gains. You start feeling like you're missing out on easy money. So you jump in, often right before the trend reverses. Let me paint you a picture of what this looks like in practice. Meet Sarah, a composite of many investors Richards has worked with. In 2007, Sarah noticed that her friends were making money flipping houses, so she took money out of her diversified portfolio and bought rental properties. When the real estate market crashed in 2008, she panic sold the properties at a loss and moved all her money into gold, which had been rising steadily. Gold performed well for a few years, but then started declining in 2012. Feeling frustrated, Sarah sold her gold and moved into tech stocks, which had been the best performers. Then came the crypto boom, and she couldn't resist putting a significant chunk of her savings into Bitcoin near its 2021 peak. Each move seemed logical at the time. Sarah was following the data, buying investments that had strong recent performance. But by constantly switching strategies, she managed to buy high and sell low repeatedly. Over 15 years, while a simple diversified portfolio would have grown steadily, Sarah's wealth actually declined in real terms. This story illustrates what Richards calls the performance trap. When we see an investment that's done well recently, our brains assume it will continue to do well. This is called recency bias. We give too much weight to recent events and assume they'll continue. But in financial markets, what goes up often comes down, and what's out of favor often comes back into favor. The data on this is striking. Studies show that investors who frequently switch between funds or strategies significantly underperform those who stick with a consistent approach. The reason isn't that they're picking bad investments, it's that they're changing strategies at exactly the wrong times. Here's one of Richards' most powerful insights: the trick isn't picking the perfect investment. It's sticking with a good one. A mediocre investment strategy that you stick with for 20 years will almost always outperform a brilliant strategy that you abandon after 2 years of underperformance. But why is sticking with a strategy so hard? It's because good long-term strategies often look foolish in the short term. When your diversified portfolio is up 8%, and your neighbor's crypto holdings are up 80%, it's natural to question your approach. When your index funds are down 20% and cash is earning 5%, it's tempting to think you're being stupid. This is where having a long-term perspective becomes crucial. Markets are incredibly efficient at humbling investors who think they can outsmart them. What looks like genius in year 1 often looks like folly in year 5. The investors who build real wealth are those who can resist the siren call of whatever's working right now and stick with a sound long-term strategy. The antidote to performance chasing isn't to ignore performance entirely. It's to focus on the right kind of performance. Instead of asking what's the best investment right now, ask what's a good investment that I can stick with for the next 10 to 20 years. Instead of chasing last year's winners, focus on building a portfolio that can handle multiple market environments. Part 5. Planning versus forecasting. Here's a scenario that plays out in financial planning offices across America every day. A client sits down with their advisor and asks, "Where do you think the market is headed?" The advisor then pulls up charts, discusses economic indicators, and makes predictions about what might happen over the next year. Both parties leave feeling like they have done something productive, but Richards argues they've actually wasted their time. Why? Because they've confused forecasting with planning, and these are two completely different activities with very different outcomes. Forecasting is about predicting the future. It's trying to figure out whether stocks will go up or down, whether interest rates will rise or fall, whether we'll have a recession next year. It's seductive because it makes us feel like we have control over uncertainty. The problem is, it doesn't work. Even professional economists, with all their models and data, have a terrible track record at predicting major economic events. Planning, on the other hand, is about preparing for an uncertain future, without pretending to know exactly what that future will hold. It's about building flexibility and resilience into your financial life, so you can handle whatever comes your way. A good plan doesn't depend on being right about the future, it works regardless of what happens. The planning approach acknowledges uncertainty, transaction costs, and tax consequences. Third, the more moving parts your strategy has, the more opportunities there are for something to go wrong. But perhaps most importantly, complex strategies are harder to stick with. When you have a simple strategy that you understand, you're more likely to maintain it through market volatility. When you have a complex strategy that you don't fully understand, you're more likely to abandon it when things get tough. The beauty of simplicity isn't just in the returns, it's in the peace of mind. When you have a simple strategy that you understand and believe in, you can focus on the things that actually matter, earning more money, spending less than you earn, and sticking with your plan over the long term. Richards reminds us that clarity beats cleverness every time. A simple plan that you can explain to your spouse and that you will actually follow is infinitely better than a sophisticated plan that sits in a drawer because it's too complicated to implement. Part 8. Build a framework for smarter decisions. Now that we understand why we make poor financial decisions, let's talk about how to make better ones. Richards doesn't just diagnose the problem, he provides a practical framework for improving your financial decision-making in real time. The foundation of good financial decision-making is what Richards calls decision filters. These are simple questions you can ask yourself before making any significant financial move, that help you step back from emotional reactions and think more clearly. The first filter is alignment with values. Does this decision align with my core values and long-term goals? This question forces you to connect any financial decision back to what truly matters to you. If you're considering an investment because it seems exciting or trendy, but it doesn't fit with your risk tolerance or timeline, this filter will help you recognize that. The second filter is the future self-test. Will I regret this decision in 5 years? This is incredibly powerful because it forces you to think beyond your current emotional state. When you're caught up in fear during a market crash, ask yourself, in 5 years, will I be glad I sold everything and moved to cash, or will I regret missing the recovery? When you're excited about the latest investment fad, ask yourself, in 5 years, will I be glad I put 30% of my portfolio in this, or will I wish I had stuck with my diversified approach? The third filter addresses emotional decision-making. Am I reacting emotionally right now? This isn't about eliminating emotions, it's about recognizing when they're driving your decisions. If you're feeling scared, excited, frustrated, or desperate, that's a red flag that you might not be thinking clearly. It doesn't mean you shouldn't act, but it means you should slow down and make sure you're making a thoughtful decision, rather than an emotional reaction. But filters alone aren't enough. Richards emphasizes the importance of what he calls buffer time, creating space between your initial impulse and your final decision. This is where the phrase, time plus space equals better choices comes from. Here's how this works in practice. When you feel a strong urge to make a financial move, don't act immediately. Instead, write down what you're thinking of doing and why. Then wait. Maybe it's 24 hours for smaller decisions, maybe it's a week for bigger ones. During this waiting period, talk to someone you trust, a spouse, a friend, or an advisor who can give you perspective. Often, just the act of waiting will change your perspective. The market volatility that seemed so scary yesterday might feel more manageable today. The can't-miss investment opportunity might not seem so urgent after you have had time to research it properly. The goal is to make fewer mistakes and smaller mistakes, and to make them for better reasons. When you have a framework for decision making, you're less likely to be whipsawed by market volatility, or caught up in the latest investment trend. Part 9. Forgive yourself and move forward. Let's address something that's probably been on your mind throughout this summary: the financial mistakes you have already made. Maybe you panic sold during the 2008 crash. Maybe you bought tech stocks at the peak of the dot-com bubble. Maybe you took on too much debt or failed to save for retirement when you were younger. If you're beating yourself up about past financial decisions, this section is especially important. Richards makes a crucial point that's often overlooked in financial advice: everyone makes money mistakes. Everyone. The most successful investors, the wisest financial planners, the most disciplined savers, they have all made decisions they regret. The difference between people who build wealth and those who don't isn't that wealthy people never make mistakes. It's that they don't let their mistakes paralyze them. The psychology of financial mistakes is fascinating and destructive. When we make a bad financial decision, we often compound the damage by obsessing over it. We replay the decision over and over in our minds. We calculate how much money we lost by making the wrong choice. We use the mistake as evidence that we're bad with money, or destined to fail financially. This kind of thinking is not only painful, it's counterproductive. When you're focused on past mistakes, you're not focused on future opportunities. When you're convinced you're bad with money, you're less likely to take the steps necessary to improve your financial situation. Richards also emphasizes that financial health, like physical health, is about progress, not perfection. You wouldn't expect to run a marathon without training, and you wouldn't give up on exercise entirely because you missed a few workouts. Similarly, building wealth is a lifelong practice that requires patience, consistency, and the ability to get back on track when you inevitably make mistakes. One of Richard's most powerful insights is that making smart financial decisions is a skill that improves with practice. The more you use decision-making frameworks, the more you reflect on your values, the more you understand your own behavioral biases, the better you will get at making good choices. But like any skill, it requires practice, and practice involves making mistakes. Here's a practical approach to dealing with financial mistakes. When you realize you have made a poor decision, ask yourself 3 questions. First, what can I learn from this? Second, what would I do differently next time? And third, what's the best move I can make from here? The first 2 questions help you extract the lesson. The third question helps you move forward. Often, the best response to a financial mistake isn't to try to undo it, but to refocus on your long-term plan and make sure you don't repeat the same error. Remember Richard's key insight: making smart decisions is a lifelong practice, not a one-time achievement. Every day brings new opportunities to make better choices. Your past mistakes don't define your future financial success, your future decisions do. Conclusion: bridging the behavior gap. As we wrap up our journey through Carl Richards' insights on the behavior gap, let's step back and see the bigger picture. The central message of this book isn't that you need to become a brilliant investor or master complex financial strategies. It's something much simpler and much more powerful. Financial success is primarily about managing your behavior, not maximizing your returns. Let's crystallize this into 4 key takeaways that you can implement immediately. First, focus on what you can control. Stop worrying about whether the market will go up or down next month and start focusing on whether you're saving enough, whether your investments are low cost and diversified, and whether your financial plan aligns with your values. These are the levers you can actually pull. Second, keep things simple. The most successful investors aren't the ones with the most complex strategies, they're the ones who can stick with good strategies over long periods. A simple portfolio that you understand and can maintain is infinitely better than a sophisticated approach that you will abandon when things get tough. Third, be honest about your emotions. Don't try to be a robot when it comes to money. That's impossible and unnecessary. Instead, acknowledge when fear, greed, or other emotions are influencing your decisions. Create buffers between your emotional impulses and your financial actions. When you feel strongly about making a financial move, that's often the best time to slow down and think it through. Fourth, make values-based decisions. The most sustainable financial plans are built on a foundation of personal values, not external expectations. Know what matters most to you, and let that guide your financial choices. When your money decisions align with your values, you're much more likely to stick with them through good times and bad. The behavior gap is real, and it's costly. But it's not inevitable. With awareness, planning, and discipline, you can avoid the emotional traps that sabotage so many people's financial futures. You can be the investor who earns the returns that their investments actually deliver, rather than the one who buys high and sells low. Remember, this isn't about perfection, it's about progress. You will still make mistakes, but they will be smaller mistakes, and you will learn from them faster. You will still feel emotions about money, but you won't let those emotions drive your decisions. You will still face uncertainty, but you will be better prepared to handle whatever comes your way. Thank you for joining me for this exploration of Carl Richards' The Behavior Gap. Remember, financial success isn't about being the smartest investor in the room, it's about being the most disciplined. Keep it simple, stay focused on your values, and most importantly, keep moving forward. Your future self will thank you for the better decisions you make today. If you found this valuable, give it a like, share it with someone who needs to hear it, and subscribe for more summaries.